So with interest rates getting between 7 and 8% as a norm today, what is exciting and new in the mortgage industry? We're talking with Rhonda today, and she has some fantastic information to share with us about things that are happening in the home loan industry that could be of serious benefit to you today. So, hey, Rhonda, how are you?
Hey, Melissa, doing excellent. I just got back from a travel day, so things are a little disheveled today. Sorry about that.
Also, while you were away on your little vacation, it sounds like some things came up to play that are pretty exciting. So let's talk about, you and I have been talking about behind the scene camera, not talking about it on camera, about HELOCs. And I've been asking, what's going on with HELOCs? When are HELOCs going to come back? And today you sent me something that was so cool about HELOCs. So tell me what's going on with HELOCs and what is a HELOC?
Right. So a HELOC is a home equity line of credit. And so basically you're pulling some of that equity out on the line of credit that you have built up into your home. So if you bought it a few years back and you had a super low interest rate, you've been making payments on it for a few years, and on top of that your appreciation has built this big bank of equity, and maybe you need to get rid of some debt. Maybe you have some home improvement projects you want to do. Maybe you need a new car. Maybe you are looking to invest in other real estate. So you want to access that equity. Well, traditionally, the only way to get that money out of your bank of your house is to refinance it. Well, when you refinance it, then you're going to get rid of that really nice low interest rate that you have right now. And then you're going to borrow more money than you had before at a higher interest rate. And so the home equity line of credit is a way to get some of that money out of your house bank and put it in your pocket to do these different projects that you want to. Now, the reason why this HELOC is very interesting to me is that in all my history of doing mortgage loans, typically the only time you can take advantage of this kind of a loan is if it's for your own primary residence. If you have a second home somewhere else, or if you have investment properties that are just rentals, then the only way to get any of that money out is to refinance that whole thing like we just talked about. So this HELOC allows you to do your primary residence, it allows you to do second homes, and it allows you to do investment properties. And so that's a super unique thing. The other thing I find really unique about this one is that it's a fixed rate. Every other one, if you go price it out anywhere, you're going to see that it's an adjustable rate. Well, as we're seeing happening with these rates right now, they keep going up, 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 up. So with that adjustable rate, then guess what's going to happen? Your payments are going to continually go up with those interest rates increasing. And so this one being a fixed rate, then you're safe. You know exactly what those payments are going to be at the maximum that they approve you for. And the approval process, Melissa, takes between 3 to 5 days to close, to fund it, right? And so everything is automated. Everything, you go online, you do a super quick little one-page application. You link your information to your bank account, to your pay stubs, to the IRS for W-2s or tax returns or whatever, and it like instantly pulls all that information and does all of its calculations. You don't even need to do an appraisal because it's going to provide an automated valuation through the system. So it's all automated. And there is zero cost to the client. Zero cost for any of those services. That's all covered through this loan program. And so the only fee that you're going to ultimately end up paying is a loan origination fee. And depending on whether we can electronically sign the documents or if we need a mobile notary, then there may be a notary fee. Otherwise, none of these other fees are passed on to the client. And that's like huge because those fees are so extreme sometimes. And the other thing that's really cool is that they'll give you terms of 5, 10, 15, or 30 years. And so they're fixed for that period of time. You can keep your monthly payments down very, very low, but obviously you can pay extra if you want to get it paid off. So it's a really exciting new new way of doing home equity lines of credit. So I think that that's a really big advantage for people that need to access that bank of money that they have in equity in their homes.
Because they haven't been able to think about that since fall of 2022, because once interest rates started going up to 5%, now we're almost at 8. Why would I refinance my 2.5% mortgage? So this now gives those people that owned their homes, they went in and refinanced them. They were smart about their refinances. They didn't take out a chunk of change. They were very logical during that 2.5% interest rate situation. And now with the equity they've built, because appreciation nationwide sits at between 3.5% to 5% annually. So they've owned it 3 years with their new loan, and now they have 15% equity. So they've got sitting on a way better equity position. And now they could take some money out. And it sounds like with this one being a fixed rate, good for primary residence, second homes, or investment properties. Those two right there, I've never seen that. Never.
No, I haven't either. I haven't either. So I'm really excited for that because our poor investors and people that own second homes, they have a lot of equity built up in their properties and they haven't really had a good tool to access any of that equity before now. So I'm really excited about that. Now we also do have what they call a closed-end second. The reason why the HELOC is pretty popular is because as you pay that balance down, then you can go redraw that money again. It's kind of like a big fat credit card, right? So you charge it up, and then as you pay it down, you can charge it back up again. And so that gives you a little bit of flexibility. Now the seconds for equity means that I need to pull $50,000 out of the equity in my home. I'm going to get a $50,000 loan. I'm going to make payments until that's paid off. And once it's paid off, it's said and done and closed. But we do have that option as well because sometimes people have a very specific purpose for that money and they don't need to access more of it later on. I need this much money right now to do this project and then I just want to pay it off and have my equity back. And so this would be another possible tool for that situation. And these ones will let you go anywhere from $35,000 to $500,000. And so you can get quite a little, depending on your equity, of course, quite a little chunk of change. They will allow for a primary home and a second home, but this one does not allow for the investment properties, which is what we generally see, which is why the HELOC is so exciting right now. So we do have those, and that will go for 10, 15, 20, 25, 30-year terms, and so it's just another fixed rate product. And we're liking the fixed rate products right now because we're seeing this, very volatile interest rates. And with the adjustable rate mortgages, you're going to see your payments continuing to be very volatile on adjustable rate mortgages. So the fixed rates are really nice.
Well, what I like about it is you just shared that. So I've been sitting on my home for a while. It has a bunch of equity in it. This second is a one purpose typically. So now I've identified that I want to go buy an investment property. So is there anything new out there for investment property buyers? Because I know for a while it's been a little ugly for our investment buyers.
Well, it has been. Now there's the investors that purchase a piece of property for the sole purpose of it being a rental investment property for them. But there are home buyers that want to live in that property for a little while and have multiple units, two or three other multiple units that's going to help them make the mortgage payments for them, right? While they buy this, perhaps a fourplex, let's just say. Well, historically, we've had VA. VA would allow you to do up to 4 units with zero down payment, and that was great. But you have to qualify as a veteran. FHA would allow you to do that with 3.5% down, and that was great. However, FHA required that we do a self-sufficiency test to show that this property would be 101% self-sufficient should all the properties be rented. So the owners would never have to take a penny out of their pocket in order for that fourplex to run solely on its own, that it would be totally covered by the rents that it's generating. And with the higher interest rates, that's getting harder to do right now. So it's getting harder to show that self-sufficiency test being able to do that. And so Fannie Mae and Freddie Mac came up with a new option for the owner-occupant multifamily buyers. Whereas if you were going to buy a duplex before, actually currently, you would need to do a minimum of a 20% down payment. But if you were going to buy 3 and 4 units, you would need to do 25%, even as your own primary residence. And so that's a chunk of change to come up with. Now, as of November 18th, I believe it is, then they're going to allow you to get in with only 5% down on both 2, 3, or 4 unit properties. This, in my 40 years, I have never seen conventional loans with such a low down payment on the multifamily properties. And the benefits are that we get a little bit higher loan amounts with conventional loans than we do with FHA. You don't have to be a veteran to take advantage of the VA loans. And we don't have to do that self-sufficiency test like we do with the FHA loans. And so if you're going to be living in one unit and the other 3 units come pretty close to covering your mortgage payment, either all or part of it, then you're good as long as you can handle the rest of the payment on your own. The property does not have to necessarily be self-sufficient like with FHA.
That's exciting because I have several investor clients that have been wanting to sell their investment properties because they're at the 19 and a half year mark and their depreciation is getting ready to go off the table. So they reached out to me to sell it. The problem is they were 4 units. And for that first-time home buyer or that buyer that wanted to buy it as a owner-occupied to occupy 1 unit, they had to put 25% down. So that shrunk our buyer pool. That shrunk our buyer pool to either FHA, VA, or a cash buyer. And so the problem too with the FHA with self-sufficiency tests that I'm seeing across the board is that we have a lot of investors, because of the pandemic and everything else, they've been very generous to the tenants and they haven't been raising the rates horribly, because part of their fear is if we raise the rates and those people move out, then we have to update and remodel this unit and I can't get the supplies for it. I can't get the new stove. I can't get the new countertops. It takes months and months to do that. So instead they're like, let's just keep them there. And the rents, I have yet to pencil out in the last probably 13 months a property that penciled out for FHA self-sufficiency. There was nothing on the market that would do it because the rents were too low, and that's what they are. So I love that because I have 2 buyers right now that this will work perfect for. They have the 5% down. They don't have 25% down. They want to live, like you always say, don't buy a duplex as an owner-occupied, buy a triplex or a fourplex, because then you have at least 2 to 3 other units to help support your mortgage payment. So this works great. So I am so excited. I'll reach out to both those buyers today and share that with them because that makes more sense.
Right. And it even is fairly generous in that the borrowers need to come up with the first 3% down out of their own pocket. But if they have family that's willing to help them out and can help gift them some cash to close, then as long as they've covered the first 3%, the rest of it can all come from a gift. And so that's even better than the FHA 3.5% down payment loan as well.
Because especially of the 2 buyers I'm thinking about, they have, one of the purposes is to, one of my buyers is not, she loves her family, but she really doesn't want to live with her mother for the rest of her life. She would like to buy something that's a fourplex and have her mother live next door to her family. So mom is willing to contribute and she was going to have to go FHA, but we just couldn't find a property that would pass the self-sufficiency test. And it's I mean, and if you as a buyer are out there shopping right now with a real estate agent and you are looking at doing FHA for investment property because you want to own or occupy and you want to buy a threeplex or a fourplex, if your agent isn't running that self-sufficiency test, then you need to be talking to your lender to do it, because the problem I see is the lender requires it to be done. The appraiser looks at that. And so why put yourself in that bind to go pay for a home inspection at $1,500 to $2,000 for a fourplex today when it doesn't even pencil out for the FHA? So this is huge news. That's going to open the door for these investor clients who have been wanting to offload some of their units, but they haven't been able to because we just don't have, typical buyers don't have 25% down. When was the last time really, Rhonda, even with your regular single family residence, how many people today are putting 25% down to move into their new house?
Yeah, and really they're not, because even with these rates increased, it still makes more sense to keep your money liquid. If you have the money and you can keep it liquid for your own self, then it makes a lot more sense to do that. Because for every $1,000 you put down in down payment, you're saving about $7 a month on your payment. And so, it takes lots and lots and lots of thousands to really make a big impact on your monthly payment. So can you make more than $7 a month if you have that $1,000 invested somewhere? And that's the question that we always want to make sure that we're asking and thinking about and just kind of analyzing. Sometimes the answer is yes. Sometimes the answer is no. Sometimes that monthly payment is way more important to get that down as low as we can versus having that cash. But I always like to see that you have liquidity, and especially with a multifamily, because you're going to have a vacancy, you're going to have a repair, you're going to have an expense. You may decide you don't want to be the property manager and you want to hire one. So you need to be prepared for some of those extra expenses of having 4 living units that you're responsible for. And so having that liquidity is super important. And I always say it's important to have it for things that might go wrong like that, but you need to have that available money to take care of. But also things that might go right. So I don't know about you, but I remember distinctly several times in my life that I said, oh, if only I had $10,000 or $20,000, if I would have done that deal, then look what it would have been worth now. But at the time, I either didn't have the $10,000 or $20,000, or I didn't feel like it was important enough to pull it out of my little safety net monies and put it into this investment that could have made me a lot more money. So keeping that liquidity for things that go wrong, but also things that can go right, I believe is a lot more beneficial than saving $7 a month.
So if you're out there thinking about that, these loans, so the HELOC is available from you through Cornerstone, the second mortgage, and of course, what did you say, November 18th? Was that the date? So November 18th, can we already be out shopping? Or does that loan not become available until November 18th? So we probably shouldn't be encouraging our buyers. They should go get pre-qualified starting November 18th?
Yeah, we can pre-qualify. We just can't get an accepted offer and create a full application until after November 18th. So we can get preliminary stuff. Yeah.
Okay, and then, well, it's very exciting because that opens up the door for that buyer who wanted to build that portfolio of real estate, but they couldn't get their foot in the door unless they were active duty military or had served the country and were a veteran. That was really the only option.
Right. Yeah, and I'm really glad to see these kind of innovative products coming available. Just so that, every little boost up that we can give our clients to help it be a little bit easier for them to get into their homes or their investment properties or whatever it is they're looking at doing. Each one of these just gives them another boost to getting a yes. And that's what I wake up every morning looking to say is, who do I get to say yes to today? So, so I'm really excited for these. These are well needed in the industry, and so I'm really happy to see that they're really good products.
Okay, so starting in December, you're going to have to say yes to the answer to this question. Yes, your student loan repayment begins December, and yes, it's going to affect your debt to income ratio, correct?
Correct. So, since 2020, we've been pretty much in forbearances on student loans just across the board. If you wanted to make a payment, you couldn't. And so, in December, all of that goes away. Now, the good news is that as a lender, we always use the estimated payment in your ratios. So it's not like you went from, I qualified yesterday, but now my student loans come due and I don't qualify today, because we always used an assumed payment in those student loans for qualifying purposes, because we always knew that at some point during the next 30 years, we're probably going to have to make payments on them. So we wanted to make sure that you were still successful as a homeowner, even with those student loan payments. The differences are going to be now that the payments may be different than that calculation, that formula that we used. And so if it doesn't report on your credit report yet, we may be asking you for additional paperwork for those student loan payments. If you are under an income-based repayment plan and your payments are very low based on your current income, then we're going to be asking you for that documentation so we don't hit you for more of a payment than what you really have to pay. So just be prepared for a little bit more documentation on those student loans, since we know they're coming up now in December, so that we can make sure that we do the calculations correctly for you. And with the income-based repayment plans, then if your income increases, your student loan payments are going to increase. So it's still good that we can qualify you with those lower payments, because if your income increases, then you can handle those higher student loan payments with the increased income. So anyway, just be prepared for that. These are coming about. There were things happening kind of behind the scenes that you may not have known that we were doing, but we were still assuming at some point you're going to have to make those student loan payments. But now that they're coming due, then they may not catch up with credit bureaus, and so we may need some additional documentation.
Well, that makes sense, because truly it is and was impossible to make a student loan payment. It was totally impossible. They wouldn't accept any money at all. And even people that wanted to pay them couldn't pay them. So now all of a sudden it's going to come out, and yes, there's lots of different caveats to it. So this is an exciting day for mortgage lending, and especially for our buyers out there who've kind of been wondering, oh my gosh, did I really miss the opportunity to buy? And it doesn't sound like that, because if you're sitting on a house right now, you've been wanting to buy that investment property for a while, and you have equity in your home, you can take out that chunky second and go do your down payment. And the cool thing is too, is if you've been sitting around going, we really are done renting, we really do want to start building our real estate portfolio, how do we do that? Now you can get in for 5% down, which is great news. I mean, that is fantastic news.
Huge. I've never seen this in my whole career. And yeah, even if you've been in that home for several years now and you really like your current interest rate, then this is also another way just to do those home improvements, updates. Maybe you do want to sell it in the next year or two and you want to spruce it up some or take care of some things that need to be done. Both of these are options to get those funds to be able to do those renovations that you might want to do as well.
So if you're listening to this and you have questions, at the end of this show will be a screen with the information about how to get hold of Rhonda. What I love about it, you click on her website, you click a Calendly link, and boom, you can schedule a time to either chat with her on the phone or meet with her like this face-to-face over Zoom, Google Hangout, however it all goes for everybody today. And you can meet with her easily, and she'll talk to you about what's the best options for you. What are you trying to accomplish, and how do you want to get there? If you've been thinking about starting your real estate portfolio and you want to live in a unit that you own as an investor, call her and start getting pre-qualified so that November 18th you can start shopping for that new investment property, and you could be in your new investment property by Christmas, which is pretty exciting to think about. You could end this year on a positive note, because I think right now there's a lot of people that didn't think any of this was very positive, that the interest rates going up, they just keep crushing and crushing us. So it's exciting that they've come out with some new products.
Yeah, it is. And you know, just think about this. We're not in double-digit interest rates, and you and I were talking the other day about that we were both in the industry during those double-digit interest rate days, and we did a lot of real estate, did a lot of mortgage loans. And then as those rates came down, everybody refinanced to the lower rates. And if you get in now, while these interest rates are perceived to be very, very high, then if the rates come down, then you're already secure in your home and you're enjoying that appreciation rate, because even if those rates come down, you're going to be paying more for the home with a lower rate. So are you really going to be saving that much money? Plus, you're going to have that much more competition out there because everybody's thinking the same thing. Okay, the rates are down now. Let's go look for a home. And so your competition becomes very fierce again. And we get back into that bidding wars and how much are you going to pay for that home above and beyond the list price, perhaps even. So this is a fantastic time to be getting out there and looking. And you know, I always say too, winter is a great time to be looking for a home, because you can tell things about the house, right, that you can't see in the summertime. Like, what does that driveway look like with ice and snow on it? Where are you going to plow the snow to? Do you have icicles hanging down from the roof that might show heat loss? You know, so you can tell a lot about the home. Is there cold spots in the house? You can see what the thermostats are set up and what they have to set up to keep it that nice and warm and cozy. So you can tell a lot about a home this time of year that you can't tell in the summertime.
Well, and especially because we have winter 6 months out of the year here, half the year. And you're exactly right. What we do when I'm showing houses, if we go near the window, and I tell my clients to always put your hand near the glass, and do you feel a lot of cold air coming in? Because that just tells us that is not a thermopane window, and it's not a double pane or a triple pane, and your gas bill is going to be higher. So I agree with you. Wintertime is a great time to be out shopping. So whether you're thinking about buying or selling, give me a jingle. I'd be happy to chat with you. My contact information is at the end of this video. And again, Rhonda, thanks for sharing all that exciting news. November 18th, I'm going to put it in my calendar, and I'm going to take 2 buyers out that I know right away to go shopping. So we'll chat with you next week.
All right, talk to you next week.